All right. Today is Tuesday, January 18th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's dive right into it. In focus tonight, catching a falling knife, perhaps. And then we have some macro analysis to do, specifically from the Empire State Index. And lastly, the bombshell, this time around from Goldman Sachs. And it is bigger than JP Morgan's. Let's start with catching a falling knife. The dynamics in the market are changing. The most important one is the fact that the Fed is no longer, quote-unquote, accommodative to the market. And we know that this market has been an addict to the Fed's liquidity, aka the cocaine operation. And this drug dealer, the Fed, just announced last year that they will no longer supply this market with drugs because they're seeing a side effect from all of that snorting, and this side effect is called inflation. So as the Fed, you have two choices now. You continue to supply the patient with more drugs until they overdose, meaning hyperinflation, or you take away the drugs, and in this case, the addict, the market, will suffer a withdrawal, and it's not going to be easy. And we are now seeing the withdrawal stage as the market starts to pull back and contract those multiples and those valuations that were only supported by the cocaine. No fundamentals at all. Yet the retail crowd did not get the memo yet. They continue to buy the dip over and over and over and over again. The headline reads, investors dismiss inflation fears to place record bets on stocks. Here's another one. Investors park inflation fears to renew bets on stocks. Yeah, park them over there. Long-term parking, please. No more FUD. We're going to buy the dip over and over and over again because Papa Jerome from the Fed, he got our back. Oh, wait a minute. Anyhow, here's another one. Retail investors pile into stocks at record levels. And as you can see, the inflows keep coming. They're buying over and over and over and over and over again. And somebody has to hold the bag when the movie comes to an end. And we all know who's going to be holding the bag. You and I. The retail crowd. Not the rich, not the 1%, and certainly not the corporate insiders. Another one. Retail investors are buying Bitcoin while whales are selling. Yeah, what do they know, these whales, right? We the Robin Hoodiots, we know how to buy tulips. What about the institutionals? They're also gambling with your retirement money. You know, when you go to your financial planner, you trusted investment firms or handling your retirement and your pension funds and yada, 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 all these billions of dollars, well, they're gambling with your money to score bonuses and individual benefits. And then when the market crashes and you're like, what happened? Where's my retirement? I thought you guys at X company, you guys know what you're doing. Now I got to work another 5 years, make that 10 years to retire. And you know what they're going to tell you? These geniuses, your trusted advisors. Well, you know, the market goes up and down, and these are normal cycles up and down, but you got to stay in for the long run. In the long run, you're going to make money if you hold, but if you try to time the market, oh, you're going to lose a lot of money. You're going to stay in for the long term. I'm 60 years old. Should I hold till I become a corpse and then cash in my gains? Anyways, the institutionals are also, they're not that negative, by the way. They're not hawkish yet. The net overweighting from the institutionals who are handling your money, your trusted advisors, 55% in equities, 33% in cash, 31% commodities, but they're down. Right? The positioning is down. 77% in bonds. Nobody's loving bonds right now, but they still believe in equities. Your trusted advisors and fund managers are also still bullish on the cyclical side of the stock market. They are overweight banks, 41%. How is that working so far? Did you see what happened to Goldman Sachs today? Ooh, what a beating. Anyhow, they're also overweight pharmaceuticals, 30%, industrials, 19%, materials, 16%, energy, 16%, but they're underweight. They're becoming underweight. Technology, only 1%, staples, 7%, minus 7%, so they're becoming underweight staples, and they're certainly underweight utilities, down 31%. Now, when fund managers are asked, what is the biggest tail risk? 44% say it is a hawkish central bank. 21% say inflation, 9% say asset bubbles, 7% say global growth scare, 6% say the thing resurgence. By the way, the thing is the best thing that ever happened to the stock market. Anyways, 4% say China credit contagion, 3% say US-China geopolitics. No Ukraine, no Russia. Maybe that will become more important in the upcoming days, who knows? But this is the contrast between retail and institutions, the fund managers. Retail out of whack, They continue to buy the dip like a bunch of zombies. The fund managers, they are tilting slightly bearish, slightly hawkish. But here's what's happening in the market in reality. The buying and selling action. That's what matters at the end of the day. And this is from Charles Schwab, Liz Ann Saunders. And oh boy, the market is taking a beating, specifically in the high multiple pockets, the mania pockets of this market. Look at these charts and pay attention to the red portion of the chart, which illustrates the outflows. When we talk about IPOs, the IPO index, look at that outflow, massive. And we could go even further. We're just starting here. How about SPACs? You know, Chamath, the con man, who doesn't care about human rights, right? Well, these are going down. The outflow's been going on since March. It started with the insiders. The insiders are dumping, they're cashing in. And then it takes a while for the retail crowd who bought into the SPAC mania to start to get out. But the outflow from SPACs is accelerating. How about the Goldman Sachs retail favorites? Well, the outflows are accelerating, but we're just getting started here, so this could fall down dramatically. How about the most shorted? Because the retail crowd loves the most shorted stocks. The short squeeze. And you end up getting your head squeezed instead. Look at the outflows here. Accelerating, and it could get a lot worse, and it will get a lot worse. Another one, how about non-profitable tech? You see, the retail crowd, the geniuses that they are, they invest in non-profitable tech. That's the future, bro. You gotta buy the future. Who cares about profits? Profits are for losers. Well, non-profitable tech is down about 50% from the top, and the drawdowns are accelerating. We haven't seen the bottom yet in non-profitable tech. How about AMC? What a beating today, right? Look at the drawdowns, diving down. We have plenty of room to go here. The drawdowns might not stop until we get to 10 on AMC. GameStop, even worse than AMC because at least AMC has over 69% drawdown. GameStop has about 68, so it has more room to fall down here. But in the battle of the diamond hands, who has the strongest diamond hands? We could say comfortably, it is the GameStoppers, not the AMC apes. The apes are bailing out so fast. Oh boy. And why is all of this happening, by the way? The drawdowns, everybody's panicking, everybody's selling, sell. What's going on here? How come the market is not going straight up like before? Well, we have a little problem that you might be aware of by now. It's called inflation. And as you can see, inflation expectations are moving higher. When they move higher, and when inflation expectations move higher, they act as the self-fulfilling prophecy because when we expect more inflation, we're going to buy now, we're going to stampede now. And what do you know? Next month, prices are going to move higher. And then inflation expectations continue to move higher. There is a spiraling effect here, ripple impacts, whatever you want to call it, doesn't matter to me. But as I told you before, inflation is a self-sustainable phenomenon. Once it's born, it's out of control. There is little you can do to control inflation, be it the fiscal policy or even the monetary policy. And this is becoming a major problem politically, socioeconomically, and it is hitting the poor, the middle class, the hardest. Those who are earning less than $50,000, 33% of those say that their financials are worse at the end of the year, meaning last year, versus the beginning of the year. So they ended the year with a worse financial condition, versus only 19% who say that their financials are better by the end of the year versus the beginning of the year. Now, when we look at the 100,000 plus income, no brainer here. The majority, 42%, say that their financials are better off by the end of the year than the beginning, meaning 2021 was great for them. Only 14% of those earning 100,000 or more say that 2021 was bad financially for them. So again, the bottom line is inflation is hurting the poor, the middle class the most, and this is becoming a political problem for the Democrats. And the remedy for inflation, at least the one we know for now, is aggressive tightening policy by the Federal Reserve, meaning raising interest rates higher. An even famed investor and douchebag Bill Ackman says that the Federal Reserve needs to shock and awe the stock market with one big rate hike to restore credibility. Maybe instead of 25 basis points, maybe 50 to shock the stock market. Perhaps this is what Mr. Ackman is suggesting here. And I bet you $1 million that Ackman is short the market right now. And by the way, we are already pricing 4 interest rates this year. 4, that's in the bag already. The only hope for the bulls to turn things around is for this expectation for this pricing for interest rates to be wrong, meaning that the Fed will not be as aggressive as they expect. Maybe the Fed will hike interest rates 2 times this year instead of 4. This will be good news for the bulls. The problem is, it appears, at least for now, that 4 is not enough, and perhaps we need more, because when you look at market expectations today, versus just 1 week ago, the majority of the market is now pricing 4 interest rate hikes, 100 basis points, and almost with 100% certainty that the first hike will happen in March. But the moral of the story from this chart is, look at how far we moved just from 1 week ago. Who's to say that next week inflation expectations are not going to move higher, and now we're going to price in 5, 6, 7, 8 rate hikes. This is how the pain is going to snowball. And it all depends on the flow of data that we're going to get. And the data doesn't look good at all. Wait for the Empire Manufacturing Index in a second, but here it is. Now, when we talk about global CPI, the Global Consumer Price Index, the expectations are actually down. Net 48% expect lower CPI. And this is the most since 2009. So what's going on here? On one hand, we have inflation expectations rising higher here in the US. On the other hand, we have another survey that says 48% expect a lower CPI. And this is the highest percentage since 2009. To answer this question, let me tell you this. What happened back in February 2009? Does that answer your question? Because you got to remember what Mohamed El-Arian said. Inflation will go down. The problem is it going to go down for the good reasons? Meaning the supply is easing, it is catching up with the demand? Or is inflation going to go down for the bad reasons? That the Fed is tightening, the economy is slowing down, and as a result of all of that, inflation will go down. This is the bad outcome. I think you know the answer. You know that the CPI will go down for the bad reasons. Either a massive slowdown in the global economy or the Fed aggressively tightening the monetary policy. It could be a combination of both, and that will be the worst case scenario. To answer the question for you, using the facts, look at the spread between the rate on the 30-year versus the 5-year. We are now reaching the same reading that we got back during the shock of the pandemic in March 2020. Now, what does that mean? It means that the yield curve is flattening big time. When the yield curve flattens, it's not a good sign for the economy because you expect that the 30-year will pay more than the 20. If you're holding a bond for 30 years, it is rational to expect that you're going to get paid more than holding a bond for 20 years. But this is not what's happening right now. The 20 is pretty much head-to-head with the 30. Soon enough, the 10-year will pay more than the 30. And if the 5 starts to pay more than the 10 and the 2 pays more than the 5, then we have an inverted yield curve, and that is always a precursor to an upcoming recession. Now, here's what we got, the bomb from the Empire State Index that we got today. The headline reading is down big. Look at this. We're about to dip into negative readings on the Empire State Manufacturing Index. What happened to the roaring 20s? What happened to the booming economy? A negative reading means that the level of economic activity is slowing down by a lot. And this was not just a miss. It was a massive miss, a big one. The expectations were that the reading will come out at 25. We went down negative by 7 points. So this is way off. A massive disappointment by the Empire State Manufacturing Index. When we look at the current indicators, they're down big. I've never seen such a drop in 1 month so fast. And I've been covering this index for a long time now. The headline reading is down 32.6 points. New orders are down 32 points. Shipments down 26 points. This is unbelievable. It's a massive slowdown in economic activity. We could say that this is due to the rise of the Pokemon variant. It is slowing down everything after all, including prices. Prices paid went down by 3.5 points. Prices received went down by 7.5 points. Yet notice the prices paid and prices received, the hit to those is a lot lighter than the headline reading. But here's the problem and the alarming note. We'll look at the forward indicators. For prices paid, the expectations are they're going to move higher by 10.6 points. Prices received will move higher by 1.8 points. And oh, by the way, the 6 month ahead prices received shot up higher to all-time highs. What does that mean? Whatever dent we're having right now in inflation is quote-unquote transitory, and inflation is going to rip higher once again. The problem is, what if the pace of economic activities doesn't rip higher hand in hand with inflation after the Pokemon variant is gone? If that happens, then we will face stagflation in this economy. Now, when we talk about inflation, we have to talk about the stickiest part of inflation, which is wage inflation. And that leads us to the bombshell from Goldman Sachs. We got some earnings today from Bank of America, Charles Schwab, and Goldman Sachs. The bomb came from Goldman Sachs. The stock crashed down almost 9% today, and the reason is wage inflation. And it's not just that, by the way. It is also combined with the slowdown in the stock market mania. So this is a double whammy in Goldman Sachs. Goldman traders disappoint, while compensation payouts soar. What are they talking about here? Goldman CEO says he sees real wage inflation everywhere after 33% jump in pay expenses. 33% jump. Unbelievable. And before you celebrate and say, hey, our wages are going higher, who cares about inflation? Federal Reserve, Papa Jerome, please don't stop the party. You better wake up here and sober up, by the way, because net, you're losing wages. When you pin your wage increases against inflation, you're down about 2 points. Because inflation at 7%, your wages at around 4.7% increase. And it's not just happening in the US, by the way. Even in Britain, the UK, they're down. Their wages down. When you adjusted the inflation, they're down. So once again, inflation is not good for the poor, the middle class, average folks. Not good, despite what they try to sell you on TV, that, oh, your wages are going higher. They're actually not. Inflation is good for the rich. The value of their assets shoot up higher, their stocks, their real estate portfolios, their art collection, their car collection, their farts in a jar collection, they all move higher. But for average folks, you're down 2 points. And it's going to get worse, by the way. You'll be down 5 points before you know it. And it's not just wage inflation, by the way, that hit Goldman Sachs today. It is the results. They're not good. Look at the revenues, for example, by segment. Investment banking, the revenues were up 45% year over year, but up only 3% quarter over quarter. And please pay attention and distinguish between year over year and quarter over quarter. Year over year, the assumption is the numbers should be hot, but quarter over quarter is a better leading indicator because it can show you if things are slowing down or accelerating higher. And in this case, they're slowing down dramatically. You're up 45% year over year, but you're only up 3% quarter over quarter. Global markets, down 7% year over year and down 29% quarter over quarter. Asset management, down 10% year over year, up 27% quarter over quarter. All in all, the net revenues up 8% year over year, but they're down 7% quarter over quarter. So again, they can blame it on expenses. That's true, but there is another side to the story. The revenues are also slowing down. To illustrate the hit from expenses, look at net income, the net earnings in this case. Year over year, down 13%, quarter over quarter, down 27%. Now, don't get me wrong. These earnings, from a dollar amount perspective, are impressive. These are massive numbers. But we look at the ratios as leading indicators whether things are slowing down or accelerating. In this case, for the most part, they're slowing down. The problem here is, folks, across the board, not just with Goldman Sachs. In the last couple of years, we had, shall we say, an extraordinary situation here with the pandemic and the tsunami of liquidity. Trillions and trillions and trillions of dollars. These trillions, for the most part, washed their way across the system. From consumers, to corporations, to stocks, to real estate, to commodities, etc., etc., etc. So we're seeing these massive bumps in earnings in 2020, 2021. But how can we sustain these results, these corporate earnings that got shot up higher in 2020, 2021 due to extraordinary measures, which are the stimmies, the tsunami of liquidity, yada, yada, yada. How is the consumer and the economy organically supposed to match up with these results that were elevated artificially in 2020, 2021 due to the tsunami of liquidity, the trillions and trillions and trillions of dollars printed by the Fed? It's almost impossible. To illustrate this for you, forget about Goldman Sachs. Look at retail sales. We're seeing a massive jump higher in 2020, 2021. And this pop higher will not likely be matched maybe forever because the underlying conditions that resulted in that massive pop in retail sales, these conditions are transitory. Believe it or not, the pandemic is transitory. And therefore, they want to keep this racket going on with the fear porn all over the place because once all of that is gone, it will be almost impossible to match this performance. Be it in retail sales, be it in corporate earnings. You're seeing it right now with banks. You're going to see it soon enough from tech earnings, from retail earnings. Maybe the fourth quarter will be the last boost for companies like Amazon, Apple, etc. But after that, how the hell are we supposed to match this performance? It will never happen. You put two and two together and you come up with a conclusion. The pump that we saw in the stock market is also transitory. The underlying conditions that pushed the stock market this high, they were only transitory, and they're now fading away. It is impossible for the stock market organically to sustain this pop higher. And in JP Morgan's case, and today in Goldman Sachs' case, perhaps we've already seen peak earnings from these two companies, and we're not going to match this performance for years to come. And this could explain why Goldman Sachs got dumped big time today. And by the way, who saw the drop in Goldman Sachs stock happening beforehand? The answer is this guy you're listening to right now. Take a listen. Next, I have Goldman Sachs, the ticker GS. Clearly a winner for the year, a name that I own in my portfolio. I bought it earlier this year in January, and since then the name blasted higher significantly. Here's the problem. We have the double top, and we have the support line broken for now. Therefore, I bought puts. I haven't sold the name, but I bought puts for protection. In all likelihood, the negative divergence from both the RSI and the MACD indicator will persist, meaning if there is a sell-off here, if there is a need to raise cash, it will happen for winners like Goldman Sachs. And here it is, Goldman Sachs down big. I own the stock. Thankfully, I had puts ahead of time, and puts, believe it or not, they protect you from massive dumps like this. Absent of puts, I would have been down 10% now. So again, puts are insurance. They're intended to be insurance against your stock portfolio. Use them. If you have any stock in your portfolio that ran too high and you're about to face earnings, what is the harm here in buying some puts? Just in case the stock crashes for whatever reason. But we know what the reason is. Peak earnings. The forward-looking indicators, they're not going to look good. The forward guidance, not going to look good. But hey, you don't have to listen to me. You can listen to Goldman Sachs. Because Goldman Sachs says, worried about the bubble, ? Why you should overweight U.S. equities this year, according to the geniuses over at Goldman Sachs. Valuations alone are not reliable. They're not reliable signal to get out of equities, quote unquote, cautions the CIO of Goldman Sachs Consumer and Wealth Management Division. And that was just a few days before the crash in Goldman Sachs stock. So you got JP Morgan and Goldman Sachs saying, hey, come on, stop it with the FUD. Stop being scared. Put your blindfold on. And keep walking. We'll hold your hands. Oh, that's not a cliff over there. That's just the Grand Canyon. It's beautiful down there. Beautiful view. Keep walking, please. So our rich clients can dump and leave you holding the bag. Anyhow, folks, we got to move here. We got a market to cover. And let's start with the market performance today. And here we go. The Dow Industrial Average was down big, 543.34 points, or a decline of 1.51%. The Nasdaq taking it on the chin, getting whacked by 386.86 points, or a decline of 2.60%. The S&P 500, no exception here, down big by 85.74 points, or a decline of 1.84%. What about the sector's performance today? Coming up at number 1, capturing the gold, the silver, and the bronze. Energy, barely in the green, the rest of them all down. And the laggards of the day led by technology, cyclicals, and communication services. What about the advanced decline ratios? NYSE 15% advancing versus 82% declining. The Nasdaq 16% advancing versus 81% declining. Awful breadth, usually, not always, an indicator that we're about to get a rebound higher, at least in the pre-market session. When we look at the charts, and we're about to do that in a second, by the way, they're not looking good. The charts say we have more pain to come. In the meantime, we're moving on to futures. What's going on here? You thought inflation is gone? Think again. Energy prices are moving higher. Both the WTI and Brent scoring over 2% gains today alone. Gasoline up, heating oil up, natural gas up, everything's up. Besides inflation, we have some fundamental news moving oil prices higher. Number 1, Russia. Apparently, Russia is struggling to keep up with the supply hikes from OPEC+. All of a sudden, Putin is like, what? I'm supposed to hike? I'm supposed to supply more where I can't find oil. Where is oil? Is it over here? Is it over there? I don't see any oil in Russia. And of course, this is intended to keep oil prices higher. On top of that, we had an attack against an oil facility in the Emirates overnight, and this pushed crude oil prices higher. But regardless of all of these events, you and I know that inflation is moving higher, and this is the main reason for crude oil to move higher. Inflation expectations. Money is chasing oil. It is the only pocket in the stock market that is working right now. It is the only reliable commodity that is working right now. What about softs? What's going on here? We have gains for sugar and cotton. Watch out for sugar here. It's about to move higher. And then we have declines for lumber over 2% today. On the other hand, we have muted activities for cocoa, OJ, and coffee. Metals, gold muted, copper muted, yet we have gains, big ones, for silver, platinum, and palladium. And by the way, metals prices are going to move higher. I just read this piece on the Wall Street Journal today. Fascinating piece. It reads, violent crime, rising costs, put South Africa's mining industry in a deep hole. It's a fascinating piece. You can read the details on the struggle of mining in South Africa. So on top of inflation, on top of the labor shortage, the supply shortage, wage inflation, we also have crime. And crime is an added cost to production. Look at what's going on with aluminum prices over the European Union. The LME aluminum price, this is the London exchange in white. As you can see, aluminum prices are moving higher. You can't quite see it because the other part of this graph, the red part, the average cost to produce a ton of aluminum in France, that cost is surging out of whack, out of control, to the point where it's dwarfing the massive increase in aluminum prices in white. The take here is, if the average cost to produce a ton of aluminum is more than the price of actual aluminum, then they're just going to stop producing aluminum because it doesn't make sense anymore. Alcoa, for example, already shutting plants in Spain and other European countries because the cost of producing aluminum is more than the price you can sell it for. It doesn't make sense anymore. And this means that the shortage of supply in aluminum will get even worse because we have a major hub in Europe and they're not producing aluminum anymore. And if they continue to produce, they have to push the end price, the aluminum price higher, and we might see the arbitrage opportunity where European aluminum prices are higher versus US and Asian aluminum prices, like we saw with natural gas. But that is highly unlikely because if it continues to happen, aluminum prices in North America and Asia will also catch up and move higher. The likely scenario is they're going to shut down the production because to produce aluminum, you need a lot of energy. Energy prices are surging out of whack, so you're better off shutting off the production, and this will shorten the supply even more, pushing aluminum prices higher and higher and higher. And we know that aluminum is the everything metal. If prices of aluminum move higher, so will the prices of cars, homes, electronics, etc., etc., etc. And perhaps now you can understand why inflation is a self-sustainable phenomenon. And of course, minor stocks like Glencore, for example, moved higher. Since the March bottom of 2020, this stock has more than quadrupled. It is a beneficiary of what's going on with this inflation. And I've been telling you for a while, stick with the miners because they are the bullet stocks. When you have inflation, when you have wars, EV wars, chip wars, whatever wars out there, stick with the bullet stocks, and the bullet stocks are the miners. Back to the futures. What about meats? We have massive gains for live cattle futures, up almost 3% today, yet muted action for feeder cattle and lean hogs futures. Lastly, what about grains? What's going on here? Oats surging higher by over 6%. We also have wheat. Wheat is moving higher. And remember what I told you a few days ago. We got news that the supply of wheat is ample and therefore wheat prices took a dip. I told you right then, watch how fast they're going to buy the dip. Take a listen. Today, we got some bad news for wheat futures. Wheat drops with U.S. forecasting bigger global reserves. Watch how fast they're going to buy the dip in wheat futures. And here it is. Wheat futures are up by almost 4% today alone. And the reason is the demand, baby. It's not the supply. Inflation is not a supply problem. It's an out-of-whack demand problem. And the demand for wheat continues to move higher. They continue to buy the dip. The inspections for exports are near 2-month high for wheat. This is in the United States. When we talk about grains, China becomes really important in the conversation. And China is not buying U.S. farm products as much as they used to. They're buying from Brazil. As you can see, China's imports from Brazil, be it cotton, be it sugar, be it meat, be it oilseeds, all moving higher, but specifically sugar. And therefore, I'm saying perhaps we're seeing a bottom in sugar right now. We also have barley. Have you noticed that the price of the beer you're drinking right now, as you're watching this show right now, have you noticed that those prices are also moving higher, not just due to the price of glass? We have a shortage in glass, but it's also due to barley prices. Canada, one of the world's top barley exporters, is importing a rare cargo from European countries after drought decimated its harvest last year. So again, Mr. Powell, you're not just facing monetary inflation, you're also facing these weather phenomenons, the pandemic, etc., etc. It is the mother of all inflation storms. Let's go back to the futures and check how other commodities are doing. Today we got gains for soybean oil and corn. On the other hand, muted activities for soybeans and rough rice, while we have losses led by soybean meal down over 3.5% today, and then canola losing over 1% today. Moving on to the big casino, the options market. What's going on here? Coming up at number 1, the hottest table by far remains Apple at around 950,000 contracts traded today. About 63% of those were calls. And at number 2, ATVI, Activision Blizzard. They're being acquired by Microsoft. The stock jumped higher, and that excited the activities in the options market. We're seeing Activision Blizzard at number 2 with almost 650,000 contracts traded today. About 52% of those were calls. At number 3, the ticker BBIG, Vinco Ventures. This is one of the retail crowd favorite names. It popped higher today, and therefore the options activities also moved higher. With almost 550,000 contracts traded for the name today, about 85% of those were calls. What about the implied volatility, by the way? We watched the implied volatility, specifically the IV percentage. When you get to elevated readings, 90%, more than 90, the risk versus reward is not worth it anymore in the options market, be it buying calls or buying puts, because the premiums are sky high. The trick in options trading is to buy cheap and sell expensive, and you can do that when the implied volatility is suppressed, yet it is expected to move higher in the next few days, perhaps week or even months. Forget about Activision Blizzard right now, it is the outlier, but look at AMC at 37% IV percentage, meaning that the implied volatility right now with AMC is higher than 37% of occurrences in the last year. Now, last time we looked at this number was down in the 20s, so we moved higher to the 30s now. When the implied volatility moves higher, it means that options premiums are about to appreciate in value, but it also means that the direction the stock has been moving in is about to accelerate. In this case, AMC has been diving down, so the implied volatility says we're just seeing the beginning of the pain here. The implied volatility could get a lot higher, and those options premiums could move a lot higher. In this case, puts, because the stock has been moving down and the implied volatility accelerated on the downside. Let's say you have a stock with an implied volatility IV percentage in this case of about 37%, and the stock starts to move higher. Next week, the implied volatility also moves higher. You want to ride that wave higher by buying calls, of course, because the premiums will appreciate as the implied volatility moves higher. And in this case, the increase in implied volatility happened hand in hand as the stock is moving higher. So you ride that wave until the implied volatility gets out of whack, 80, 90%, and the premiums are not worth it anymore, and you dump your calls. The same story happens on the downside. If the stock is diving down and the implied volatility is surging higher while the stock is moving down, then you want to catch that wave all the way to the downside until that implied volatility surges higher to 70, 80, 90%, because at that time, when everybody stampedes to buy those put options, the stock already crashed, the premiums are too high, you who got in early scored big. I don't know if this is confusing or not, but if it is, ask questions in the comments, and I'll be happy to follow up. I'm not really that good at explaining things, believe it or not, so ask questions. But anyhow, moving on to the unusual activities that took place in the options market today, starting with the ticker HYG. We have a put spread here on the HYG, which stands for the junk bond ETF, the garbage bonds. They move higher when the Fed is easing, yet they move down when the Fed is tightening. So somebody's betting that interest rates move higher, the Fed will tighten more, and therefore the party in the HYG is over. They bought the 78 puts and they sold the 74 puts, all for the expiration date April 14th, with expectations that the HYG will drop down by more than 9%, but not more than 13.5% by then. They paid all about 40 cents a piece for the 78 puts that they bought, and they received about $25 a piece from selling the 74 puts. All in all, bringing the average down to 15 cents a piece, and that brings the total all the way to $570,000. For this trade. What about the ticker ARCC for Ares Capital? Ares, the son of Zeus, who's the god of what? If you answer that correctly in the comments, I'll send you a cookie. But in the meantime, here's the trade for ARCC. They're buying puts, the 20 puts for the expiration date, March 18th, with expectations that the name will drop down by 6.5% by then. They paid about 40 cents a piece to enter this trade, all in all spending about $670,000. And here it is. What about the trade for the ticker AMC? They're buying puts now. They're piling in, buying the 17 puts for the expiration date, January 28th, with expectations that the name will drop down by more than 10% by then. They paid about $1 a piece to enter this trade, all in all spending about $1.4 million. And what about the ticker MPC for Marathon Petroleum? They're buying calls here for more upside in this name. The $80 calls for the expiration date, February 18th, with expectations the name could pop higher by more than 7% by then. They paid $1 a piece to enter this trade, all in all spending about $1.2 million. And what about the ticker BITO, BITO? This is the Bitcoin ETF, or the crypto ETF, I should say. The buying calls here, perhaps tulips will move higher. The 29 calls for the expiration date February 18th, with expectations that the name could move higher by more than 10% by then. They paid about $1.20 a piece to enter this trade, all in all, spending about $1 million. And lastly, at the bottom of the table, what about the ticker XBI, the biotech ETF? They're buying upside calls here. Interesting. The 115 calls for the expiration date, April 14th, with expectations that the name could pop higher by more than 21.5% by then, and they paid all about $1.20 a piece to enter this trade, all in all, spending about $1 million. Moving on to the heat map analysis, what's going on here? Bloodbath across the board, very few exceptions. Energy, specifically Exxon, continues to outperform. Certain pharmaceuticals outperforming, not by much. And then we have Nutrien in agricultural, NTR moving higher. Activision, the video game names moved higher in empathy with Activision Blizzard. We have Carvana, Pinduoduo, Zscaler moving higher due to an upgrade that we got today, but that's about it. The entirety of the market is getting shot, down big across the board. And here are some of the notable movers. How about Apple? The IMOB down almost 2% today. We have some news for Apple. Perhaps not good news here, because Ericsson is filing a dispute against Apple for the 5G technology. On top of that, we have bipartisan antitrust legislation that's about to target Apple. And the IMOB is now warning senators, saying, hey, if you cut us off here, if you crash our monopoly, we'll crack your kneecaps. We'll expose your private information. Those hookers you slept with, Senator, those were underage. We got the information. And then we have Microsoft, also down big. By now, you know the news. They bought Activision Blizzard. It's not a done deal yet, because the FTC has to approve it first. And perhaps, if you are Microsoft bull, you better hope that the deal will not go through, because this is insanity. This is a reminder of the 1999 dot-com mania, with Yahoo and AOL acquiring everything under the sun with no reflection whatsoever on the price tag. In this case, Microsoft way overpaid for Activision Blizzard. I mean, the company barely produces $2 billion in profits annually. Now, let's say that the current correction in the market becomes more intense, combined with margin calls and the ETFization factor in the market, and Microsoft gets cut by half. And the valuations of Microsoft go down 1 trillion, which is plausible, by the way. What if that happens? Then Microsoft just spent at least 7% of its entire value on acquiring Activision Blizzard. That is suicidal for one company, and this kind of narrative, you're only going to find it here. All what I heard in the news, CNBC, Bloomberg, Wall Street Journal, doesn't matter. They're saying this is a great deal. Perhaps Microsoft is bargain hunting by buying Activision Blizzard at $70 billion to capitalize on the metaverse, which is the biggest scam that I've ever seen since the Tulip Mania. No, not the one in the 1800s, the one that we have right now. But anyways, we have another mover here in Affirm. AFRM down big, over 7% today. Although we have maybe some good news for Affirm, because they have a deal with Verifone to include an option, an Affirm option. So when you go to the grocery store or Home Depot or whatever, you don't have to pay right away. You can use Affirm. You buy now, pay later or never. Just click on the Affirm button, and who cares? You don't have to pay. You just take the merchandise for free. If a firm comes back to you and say, hey, where's our money? Just call the IMOB. They'll crack a couple of kneecaps on Affirm, and you'll get away with it. You don't have to pay them back. Just pay the IMOB a small cut. They'll take care of it. What about the ETF heat map? What's going on here? Down, everything is down, with exception of the XLE for energy, that's moving higher, and the SLV for silver, that's also moving higher. The TBT, the inverse of the TLT, also moving higher, but that's about it. The rest of the ETFs that are moving higher are inverse ETFs. The SQQs, the SOXS, the inverse index for chips, the FAZ, the inverse index for financials, the TZA, the inverse for small caps, the VXX, the UVXY, proxies for the VIX, and it didn't matter. Growth, value, they're all down. Be it growth, down more than value. And by the way, when it comes to inverse ETFs, if you cannot buy put options for protection, you can buy these inverse ETFs and hold them for a while until the correction is over. But be careful of holding them long term. you're gonna hold a massive, epic bag. You use them for a little while, in, out, hello, goodbye. Moving on to charts, let's start with the 30 minutes chart for the SPY. What's going on here? Gapping down in the morning, breaching 461 as support, 459, all the way down to 456 and a half. And that better hold. Otherwise, oh boy, we're going to have a massive flush down here. You haven't seen anything yet if 456 and a half is violated, or we barely closed above that by 1 penny. Clearly, the bears are in charge here. What about the daily chart for the continuous contract with the SPY, the S&P 500? Once again, the bears are in charge because we're trading below 4,657, which happens to be the bull to bear advantage line. The selling is happening on higher than average volume, another point for the bears, and another one. The negative divergences on both the RSI and MACD indicators. Even the SPY is now in negative divergence. So the bears in full charge right here. And the next support we have is 4,549.5. That is likely not going to hold if the selling continues. Because what if what we're seeing right now, if we turn off all the indicators and the lines and the markings that I have in the chart, and we switch to a line chart, what if what we're seeing right now is a head and shoulder formation? If that is the case, then eventually the chart will go down all the way to 4,333, and that will be a big correction for the SPY, the S&P 500. What about the Qs, the Nasdaq 30 minutes chart? What's going on here? Gapping down, losing the support of 376 and losing the support of 372 as well. Not a good look here for the Qs. It's not oversold yet, but it better hold at 369 for support. That is the line in the sand for me before the flush down and the gates to hell open. And here's a daily chart for the continuous contract for the Nasdaq. What's going on here? It is losing 15,500 for support, and the next support we have is 15,000. The selling is happening on higher than average volume, and the momentum indicators, the RSI, the MACD, remain in negative divergence, which means the bears are in charge. Let's turn off all the indicators, all the markings that I have on the chart, and switch to a line chart. What if what we're seeing right now is an A, B, C pattern? We saw the A, we saw the B, but we are now forming the C leg. If that happens, we're going down to breach 15,000. And by the way, here's a weekly chart for the NDX, the big Nasdaq, and oh boy, this is the most alarming of them all. We are now violating the channel the NDX, the Nasdaq, has been trading in since 2020. And we're breaking to the downside. The week is still young. We better climb the trade within the channel once again by the end of the week, because if the chart closes like this by the end of the week, then we have a confirmation that the trend is over. Hello, it's over, and we're about to flush down big time. Get your bear suits out. What about the IWM, the Russell 2000? 30 minutes chart, gapping down, losing the support of 211, and now stopping at 208. By the way, all of these lines are drawn ahead of time. They've been there all along. The algos, the traders are respecting these numbers. They're not always accurate, I'm not a robot, but most of the time they are. And now we're stopping at 208. The IWM better not lose this support. It is critically important. Next, we have the dollar index moving higher again, and it appears that the dollar index is eyeing 96 once again for support. It's going to face a little challenge over there. It's not going to be easy, but this is yet another illustration of the strength in the US dollar, the resiliency, on paper at least. Because the fundamentals are bad. The dollar should be crashing. The only thing that is supporting the dollar right now is the hawkish anticipations in the market, number one. Number two is the weakness in other currencies. Other economies are collapsing, by the way, and therefore other currencies, foreign currencies, are crashing, and this is supporting the value of the US dollar. So far, the move in the US dollar is not bothering gold. Gold is still in a bull flag formation, and it could pop higher. It is quite peculiar, of course. Why is silver up and gold not up as much? Gold was down slightly. Who knows? But the good news for the gold bulls here is the fact that the dollar was up and the 10-year yield was up big today. Yet it didn't bother gold. This is the conditioning process. Soon enough, gold is not going to give a rat's ass about the dollar and the 10-year yield, and it's going to start to move higher. This is the bullish assumption. And here is the chart for the 10-year yield. What's going on here? Popping higher, the ABC pattern, to the moon. We're eyeing 2% now. Yes, the chart is way overbought, the RSI, the MACD indicator, but again, we're unwinding years and years of negative action in the 10-year yield. So don't be surprised here if the 10-year reaches 2% in a matter of weeks. We're not going to call the top here unless we see a reversal candle. And that could happen due to a fundamental reason or a piece of news that could come out. Do we have anything in the economic calendar right now that could surprise the 10-year yield to the downside? Not really. So we have to wait for a reversal candle before we trade accordingly. How do you trade accordingly, by the way? If the 10-year yield is topping, you buy the TLT. That's the easiest one. The TLT is down big. This is a weekly chart. It appears that we haven't found a bottom yet. It could be at 134.5, but for now, the assumption remains. Yields higher, TLT down. The VIX 4 hours chart, what's going on here? The MACD indicator from 4 hours perspective remains positive. We're seeing green impressions on the histogram. Those columns are getting bigger and bigger and bigger, indicating that the pop in the VIX is not over yet, which means that the dump in the SPY is not over yet. The VIX is trading above 20. Market bears are hoping that the VIX will close above 20 for the week, but the week is still young. What about the VXN, the VIX for the Nasdaq, 4 hours perspective? Still in the green. The MACD indicator is still moving higher, showing green impressions on the histogram, and these green impressions are getting bigger and bigger, indicating that the pop is not over in the VXN, which means that the dump is not over in the triple Qs. Perhaps the VXN is eyeing the previous high at around 36. But anyhow, what about Apple, a daily chart? What's going on here? Not looking good, losing the support of 172.5. And if we turn off all the indicators, all the markings, perhaps what we're seeing right now is a reverse ABC pattern, which means the C leg is not over yet. It could take us down all the way to 160, if not below that. Another way we can look at it is a head and shoulder formation. And if that is true, then we're going down, baby. We're going down all the way to around 157. Tesla, the souffle, an hourly chart. What's going on here? Faring a lot better than the rest of technology. There is an impressive level of resiliency in Tesla. It's going to be the last block to fall, trust me. But for now, it is trading within range. The support 995, the resistance 1090.5. It is forming a bear flag. The assumption is it will go down, absent of a rescue operation. Moving on to tulips, BTC, what's going on here? It is still holding, folks, holding at 42,000, asking buyers, please show up. Now, the whales are dumping, as I showed you earlier, and the retail is buying. The whales have to step up here and buy BTC, because the longer the chart waits for buyers, and the buyers don't show up, this will turn into a bear flag formation, and the chart will flush down, seeking the next support, which is down at around 30,000. So watch out here. And lastly, AMC, tragic. I hate what's going on here. I hate to see the retail crowd getting hit hard, but can't tell you that I didn't say so. This is a monthly chart. We're down big. We're awaiting the confirmation on the MACD indicator. Once the MACD indicator crosses, producing negative impressions on the histogram on the monthly chart, you will know once and for all that this is over. AMC is going to go down to single-digit reading. And by the way, it is a little too early for the lessons learned conversation. But you can go back to my AMC videos. I'm highlighting some of them here, specifically this one, which was epic, and I warned the apes over and over and over again. And just a cautionary advice here. My language back then might have been a little more offensive and more harsh, because the apes were winning back then. Now I'm not as harsh as I used to because they're losing. I don't want to pile on the misery of the apes, but I explained to them over and over and over again, this is not going to end up well. And I nailed the trading activities of AMC precisely to the penny. You can go back and watch these videos. And look at the comments, by the way, how nasty the apes were. I was just trying to help you out here. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Not a lot, but we have important data for the housing market, building permits, and housing starts. These will be important for the housing market, and we will discuss the housing market, by the way, and the upcoming crash in the housing market in the next video. But for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.